Thank you so much, Ladi, for your time. Perhaps we should start, since it's relatively fresh, the bond auction that we saw, the first of the that we've seen this year. Can you just unpack the outcome of that and the big takeaways?
Hi, good afternoon. Thank you for having me. So, like you rightfully said, we had a monthly FGN bond auction conducted on Monday, where we saw an increment in rates across board. Typically, would have the usual amounts being offered across the 4 tenors, which is the short, and I could say the medium, and then the long tenor securities, in which I would classify the 2037s in this bucket. At the auction, the stop rates closed at 14% on the 2028. The 2032 maturity stop rates closed at 14.9%. On the 37s, stop rate closed at 15.8%. And on the longest end of the curve, the 2049 maturity stop rates cleared at around 15.9%. Going into the days after the auction, we saw a bit of resistance from some of the local players. Again, we've reached another level, another handle in the secondary markets, in which counterparties were not necessarily expecting the kind of increments that we saw. It was fairly sharp, and we saw that play out and filter into the secondary market, where we saw offers above where these securities were cleared at the FGN auction. But going into today, we've seen a bit of demand filter into the market because yields are fairly elevated. One, because of the avoidance of CRR, and two, because there are not that many outlets for some of our real money guys, pension funds and asset managers to place or deploy some of their idle funds. So we've seen a bit of demand on the short end of the curve, and this has filtered gradually into the 2037s, like I said, which cleared at 15.8%, which is where it cleared at December's auction. So we're seeing a bit of demand on that bond, given the high coupon, which is 16.28, attributed to this instrument.
I'll certainly bring you back to the bond markets, of course, the corporate bond markets this time, and with a focus on the Eurobond market following that Moody's downgrade. But before that, can you just also cast the spotlight a bit on the liquidity levels in the market right now and what that could mean for short-term rates moving on to the rest of this week?
Okay, we're at about $1 trillion naira in the system, and this is giving the bolstered liquidity level stemming from the redesign of the naira, where we have deposit money banks accepting the new notes, which has essentially increased or inflated the amount of system liquidity. With regard to the downgrade by Moody's, they cited some of our fiscal challenges within the markets, and also the ways and means in which CBN has intervened in the market in recent times. They cited it being unsustainable, and by and large, we saw most of the adverse effects impact on our Eurobond space, and not that much of an impact on the FGN space. So we saw immediately post the downgrade on Monday morning, we saw yields open a bit wide, and we saw a drop in yields, or a rise in prices, by about $2.5. So going into today, we've seen a bit of moderation, again, given the limited outlets available, given the risk appetite across the sub-Saharan African curve. So we've seen a bit of moderation in those yields, where some of the offshore guys, some of the ETFs, and also the real money guys offshore are willing to take on a bit more risk despite the downgrade. Although we're expecting S&P's results later on this week, we expect it to be a stable outlook, albeit the downgrade that's pending on Nigeria as well. But by and large, the yields have been fairly stable. Like I said today, some buying in the FGN space, and some buying as well within the Eurobond space, especially on the Nigerian curve.
Right. And back to liquidity, as you rightly pointed out, the moves to redesign the Naira and to change that in the marketplace is obviously fueling a lot of flows into the banking system, and that is increasing the liquidity in the financial system. And do you think this is resetting liquidity in any way? And if so, how do you anticipate that the central bank will react in terms of its move to continuously stem system liquidity?
Okay, so what we've seen from the last MPC is a bit more tightening from the Central Bank of Nigeria, where we have the monetary policy rates at around 17.5%, which is the highest that we've seen in a very long time. with the excess liquidity in the system, it's going to bring about a conflicting impact where the excess liquidity in system would lead to banks having a bit of idle cash, and the avoidance of CRR will result into a downward trajectory in yields as counterparties deploy their funds, like you rightfully mentioned, in the NTB space on the 19 and 25 December bills, which are currently trading around the 2% handle. Nevertheless, given the CBN stance on tightening, although we also have some tapering or some moderation in yields in terms of where inflation is as well, so we expect to see yields on the FGN curve go up a little bit, especially on the longer end of the curve, as the federal government needs to meet some of its demand in terms of funding the budget deficit.
Right. And also, as we consider the impact of this Naira redesign policy, what do you think it could mean for the exchange rate in the forex market? Do you think it's influencing any dynamics there at all in the official foreign exchange market?
It's a little bit too early to say. I think what we've faced in recent times is a paucity of funds. The INE is currently fluctuating around this 461 mark, and we expect the demand to continue to outweigh the supply. So it's very premature to say, but what we do expect to see is a continued demand for the US dollar as we've seen in the last couple of years.
All right, let's leave it there. Thank you so much for your time today. I've been speaking to Ladi Belo, fixed income trader at Access Bank.